Okay, looks like everybody's, the new people joining in has kind of subsided, so we'll go ahead and get started. I want to just say, first of all, good afternoon and welcome to Richey May's quarterly webinar on the common compliance findings as well as common pitfalls for new JennyMay issuers. My name is Kurt Blum. I'm with Richey May's Business Advisory Services, and before we go ahead and dive into today's presentation, just want to go over a few housekeeping items. First of all, for optimal audio, all the participants' phones will be muted during the presentation. We will also have a Q&A session at the end of the presentation. We do encourage questions, so you can submit a question at any time during the presentation by using the question box feature. And like I said, at the end we'll kind of go through those questions and answer as many as we can with the time allowed. And also we will post the presentation to our website after the presentation. So if anybody wants to go back afterwards and listen to it, they can, or if they miss something or whatnot. So anyway, I'd like to now go ahead and introduce today's presenter, Gail Litter. Gail is Richey May's compliance supervisor. She's been with the firm about 2.5 years and in the industry 12 years. And like I said, she's kind of our compliance guru or subject matter expert. So with that, I'll go ahead and turn it over to Gail.
Thanks, Kurt, and thank you for everyone for joining us today. As you know all too well, compliance has become an increasingly complex area of your operations. And in response to that, Richey May's created a compliance specialist position, and I am pleased to be able to provide this service to you. When we requested topics for this webinar, during the Richey May CEO Roundtable and nearly every other interaction we have with our clients recently, compliance is really an ever-present topic. So I hope that by sharing some of the most common issues we noted during 2013, we can help you make some revisions to your procedures to make sure you correct or avoid all of these issues going forward. Also, a quick note, I'll often refer to today's topics as findings. In reality, most of these items were more often just comments in our letters to the board for recommended areas of improvement, but for clarity today, I'll probably just use these terms interchangeably. As Kurt stated, we'll hold your questions until the end, but please don't worry about trying to limit your questions to just the topics that we're discussing today. I know there's a lot of areas that people have questions about. I may not be able to answer all of them right away, but I'm happy to follow up with you with all of the supporting guidance and answers after the webinar. So with that, let's get started. Today we're going to focus on the most common findings and management letter points we issued for years ending December 31st, 2013 through February 28th of 2014, focusing first on our HUD requirements. I'm going to provide you with the specific errors that we found, explain the requirements, and then give some best practices when they're available. After that, we'll focus on some of the common pitfalls and errors we've seen in our new JennyMay issuers. The common HUD compliance findings we're going to discuss today are QC reviews and EPD reviews, sending upfront MIT payments to FHA, calculating interest for FHA loans on the HUD-1, anti-money laundering program reviews, accounting for escrow balances, and communications with HUD. So before we jump into our QC findings, I'd like to point out that these are the requirements as the handbook states right now. I imagine most of you are aware of the overhaul the HUD handbooks are going through. The draft is the proposed quality control, oversight, and compliance section of the new FHA Single-Family Housing Policy Handbook, which they are calling the SF Handbook, was released June 30th. They're looking for responses and feedback until July 29th. So if you've not already done so, try to pull up the draft, read it carefully, and provide HUD with your feedback. It's important that they hear from those of you who have to implement the new procedures. The draft is quite robust. It expands the amount of information that has to be reviewed through your QC plans, and it tightens the turn times for review. I know you're all surprised to hear that meeting your compliance requirements could get even tougher, right? So for now, HUD Handbook 4060.1, Chapter 7 provides the details for all quality control expectations from HUD. Of all of the findings, the most prevalent were those related to the QC plan and the related reviews. One aspect that some clients struggled with this year included sample sizes. Some weren't performing the reviews at all. This wasn't the most prevalent issue, but would probably be considered the most serious. Others weren't testing a large enough sample, and many were not documenting the sampling method. And this happened primarily in servicing, but we did see it in some of the other areas. As most of you are probably aware, there are some different requirements for your reviews depending on if you're doing an origination review, EPD reviews, and the servicing. So let's start with origination. The requirement is either 10% of all loans or a statistical random sampling that provides 95% confidence with 2% precision of the FHA loans if your annual production is greater than 3,500. A quick note on the random sampling method. So while the language isn't included in this specific section, the other times this method is referenced in this HUD chapter, it also adds a statement that the random sampling method is okay as long as the sample size is at least 10% of the population. A lot of the random sampling methods that use the 95% confidence and 2% precision actually result in less than 10%. And so our recommendation and the best practice that we've seen most of our clients use has been to just go with the default 10% method since it's more clearly defined. I did note, however, that in the new draft, there's no comments about making sure that it's at least 10%. So there's a little bit of a question about where that's going to go in the future. But ultimately, I would say if you have the option of using the statistical sampling method, I would think the following things are important to consider. First of all, are you 100% certain that you're going to meet the 3,500 originated loans? If not, you'll have to do a lot of catch-up at the end of the year to make sure you hit the 10%. And then, are you comfortable with having a smaller sample reviewed for such a large population of loans? Are you creating too much exposure by having a smaller sample? So next in servicing, right now the QC chapter wants you to review 10% of each category of FHA loans serviced for each period. They identify the categories as servicing delinquent accounts, loss mitigation efforts, reporting under the single-family default monitoring system, foreclosure processing, missed billings, deficiency judgments, claims and claims without conveyance of title, new loans, servicing transfers and acquisitions, customer service, fees and charges, escrow administration, ARM adjustments and disclosures, HECM disbursement reporting, Section 235 recertification, assumption processing, handling of prepayments, paid in full mortgages, and maintenance of records. So a lot of areas. But HUD wants 10% of each one of those categories to be reviewed in your QC. And then, of course, all early payment defaults, 100% should be reviewed. For all types, all three, it's important to document the population, the sampling method, and the sample size for each review. The next area that we saw with the reviews is the timeliness. So HUD states that all types of reviews should be performed in a timely manner. For origination reviews, that timely manner is pretty clearly defined as the review being completed within 90 days of the end of the month in which the loan is closed. Any findings then have to be reported to senior management within 1 month. And then all fraud and other serious violations have to be reported to HUD within 60 days of discovery. And one important thing to note here is that it's not 60 days of reporting to senior management. It specifically says at discovery. So then the final report or addendum should identify actions taken, the timetable for corrections, and all of the follow-up activities. And early payment defaults are included in the origination section of Chapter 7, so we consider those same deadlines to apply to your early payment default review. Now for servicing, the paraphrased wording in the handbook is quality control of servicing must be an ongoing function. Mortgagees must perform monthly reviews of delinquent loan servicing, claims, and foreclosures. The other items listed must be reviewed at least quarterly and should address activity that occurred within the prior 3 months. Because this definition of timely is less black and white than the origination, there's been a little bit of a variety in the interpretation, and we've discussed that with certain clients. We're currently working with HUD to try to get a clarified interpretation of this paragraph, but until then, our opinion is that that statement that says address activity that occurred within the prior 3 months, it leads us to believe that HUD intends for servicing reviews to follow the same time frame as originated and EPD reviews. If we're ever able to obtain any specifics from HUD, we'll certainly communicate that with you. But a quick note here, the new draft doesn't differentiate between the types of reviews. Timeliness is a single discussion and would require that all reviews be performed monthly. The sample would have to be made within 30 days of close, and reviews must be complete within 60 days of close. So you'll note that that's actually 30 days less than we're currently given to complete our reviews. So just file that away for potential future reference. But because this is the new wording in the draft, it leads us to believe that our current position of timeliness is the 90 days for servicing reviews is in accordance with the spirit of the current guidelines, and that will continue to be our recommendation until the new handbook is released. In any case, regardless of the interpretation your company decides to take as to timeliness for QC servicing reviews, we recommend that you make sure that there's a measurable deadline explicitly discussed in your QC plan and that you document that you've followed that plan to the letter. And that brings us to our next common finding for QC, and that is the failure to include all elements of QC requirements or to execute your QC plan as stated. The QC plan should explain the company's expectations and method for implementing each aspect of Chapter 7, even if it isn't currently applicable to your business operations. So in a case where maybe you're not currently retaining servicing, my recommendation would be that you at least have a comment that those particular sections aren't currently applicable and would be added if the company's business model changes to include that feature. So basically, we would recommend that you address every paragraph of Chapter 7 in your plan, even if the only way you're addressing that is stating that that paragraph is currently not applicable. And just as the CFPB has emphasized on their compliance management systems, it's not enough to just have the right information written down in a policies and procedures binder that sits on someone's shelf. These plans should be living documents that are understood and practiced on a daily basis. So if your CMS or QC plan in this case says you do something a certain way or in a certain time frame, make sure you're documenting your regular compliance with that statement. Okay, so that wraps up the QC discussion. It's a pretty meaty topic, so I'm going to pause here for just a minute to give you time to complete any questions related to the topic. Again, I'll answer as many questions as time allows at the end of the presentation. Okay, so the second most common finding this year was delayed payments of the upfront mortgage insurance premium that was collected from the new borrowers at closing. For a multitude of reasons, this was a problem for a number of our clients in 2013. Some of the reasons we saw for delayed payments were bad reports from new loan origination systems, issues with conversions of proper dates when you've been moving into new origination systems, and a lack of backup when primary people who are responsible for forwarding those payments were out. And then there were a few that just couldn't really explain why payments were late. They were just late. So it's important to remember that purchases, refinances, and 203K upfront MIPs are required to be sent to FHA within 10 calendar days of disbursement. And heck, you have 15 calendar days. The issue was a lot more prevalent this year than in years past. So I think for everyone, this is a good area to revisit. Make sure you have monitoring procedures in place, and then maybe try to increase your turn times if you're averaging somewhere close to those deadlines. The best practices obviously are going to depend on your internal processes, what departments are responsible for forwarding those payments, whether you use a closing department or your accounts payable department. But in general, what we've seen is the clients that have the shortest turn times and are getting those payments to FHA between 1 and 3 days, they are using the batch payment option. So if your company is not using that, it might be worth taking a look and seeing if maybe that would help you increase some efficiency in submitting those payments. It's also important to note that the SF handbook draft includes a requirement to document that this area is being monitored and reviewed. So if submission of your upfront MIP remittals aren't currently included in your QC plan, you may have to add some monitoring procedures there. We also saw a number of errors in the calculation of interest collected at closing. This isn't a gray area. Daily interest calculations for all FHA loans must be made using a 365-day basis. So daily interest, or per diem, should always be calculated using the loan amount times the interest rate divided by 365 days. So again, please visit your policies and procedures in this area. Make sure this calculation is being included in your pre-funding reviews or some other applicable monitoring process. I have seen HUD come in and require a company to issue hundreds of borrower refunds for less than $1 each, sometimes just to correct this error. The labor cost to issue those refunds will far exceed the small amount of interest income that you would gain by using a 360-day basis. So make sure you're doing everything you can to catch those errors when that calculation error happens. And then, in case you were worried that you didn't have enough oversight, in 2012, all non-bank residential mortgage lenders and originators lost their exclusion from FinCEN's anti-money laundering requirements through the Bank Secrecy Act. All residential mortgage lending entities now have to have an AML program, and the program has to be reviewed through an independent audit function. Our testing found that most clients have established an AML program, but many have failed to meet the independent review requirement. If you happen to not have a written program, please have someone get started on this today. For those of you that have a program implemented, it's important to know that the program should generally be tested annually. Now, the ruling provides a vague reference to adjusting the schedule according to a risk assessment. However, the form of that risk assessment and the alternate timelines are undefined. There's really been no additional guidance in this particular aspect. So our recommendation is to be safe and meet the annual requirements to avoid violating the rules by misinterpretation. If the risk assessment adjustment option is taken, please just make sure that you clearly outline how the assessment is going to be made and applied in your program, and then faithfully document that this plan is followed. And again, as with all compliance plans, it's not enough to have the written policy. Make sure you're practicing and enforcing the policy. So we've covered a few more topics, so I'm just going to give a couple more seconds to let everyone get caught up on any notes or questions. Okay, the next two topics also have a financial statement component to consider. So let's first discuss the accounting for your escrow funds. The finding in this area we gave was usually disclosed as a failure to reconcile escrow assets to escrow liabilities. The background here is that since cash collected from borrowers for the payment of their escrow balances isn't a company asset, nor is the liability that of the company, The funds are custodial and shouldn't be reflected on the company's balance sheet. The fiduciary responsibilities of custodial funds are strict, and the funds must be managed properly. The catch here is that for most companies, the easiest way to make sure they're managing these funds properly is to create an asset and a liability GL in their accounting software. However, since these balances should be off balance sheet, those GL accounts need to always net to zero. Of course, the balances in these accounts are fluctuating every day, and they have routine timing differences. This means that there'll have to be a regular reconciliation between these accounts, including reconciling cash to the bank statement. Timing will depend on the level of activity, your staff capacity, and the way these accounts are updated for transactions, but we recommend a weekly reconciliation, but monthly at the very least. Also, if your interim servicing funds aren't segregated into an escrow bank account, we'd recommend taking some time to evaluate if that makes sense for your operations to begin doing so. Decreasing the likelihood of commingling funds is always a valuable improvement, and since this is an area of direct consumer impact, the CFPB has strong opinions about the management of these funds also. And again, the SF Handbook draft includes a requirement to document that this area is being monitored, reviewed, and is in compliance with CFPB escrow requirements. Okay, our final HUD-related topic is documenting and retaining your communications with HUD. All communications with HUD should be stored in a traceable, trackable manner. The most common line of communication is begun by a post-endorsement technical review, or a PETR letter. These letters require a response from the lender and are considered open until a response has been received from HUD. It used to be that if the response was considered acceptable by HUD, you wouldn't get any further communication from them. That's not currently the case. They should be sending you a letter telling you that all of the findings have been mitigated. I did note in the new QC Handbook draft that the only indication of receipt of an acceptable response going forward, if the draft is implemented as it exists, will be an update to the status on FHA connections in the underwriter review system. But for now, you really should be tracing those responses and confirming that you've received a response that the finding is mitigated. When there's no response from the lender or the response you provided is insufficient, a recommendation is made to the Quality Assurance Division for an indemnification agreement. Open indemnification agreements are important for you to be aware of and to continue to track. Even though they don't necessarily represent a future repurchase request, the number of open indemnification agreements could be considered relevant to your credit loss reserve analysis on the financial statement side. I personally would be really impressed if one of my clients could show me the inclusion of historical data regarding the percent of indemnification agreements that ultimately resulted in repurchase requests. But in all cases, the best practice is to at least be able to identify all correspondence received, the date of response, and any further communication, including the final resolution. So that concludes the HUD findings section of today's webinar. I'm going to pause for just another moment again, let everyone get caught up. Okay, great. Let's move on to JennyMay findings. The most common weaknesses we see with newer JennyMay issuers is inadequate communication with the document custodian, over-reliance on the SelfServicer, and lack of reconciliation. So our document custodian testing this year revealed that many pools were missing documents that were required for either the initial or the final certification. The custodian should always quickly be provided with the master custodial agreement, the schedule of pooled mortgages, the certification and agreement, and the related release of security interest when it's required, all the original notes, and any other miscellaneous documents that are required for HECM, 203K loans, and some of those other less common products. And all of those documents are required for the initial certification. And then the pool must have a final certification completed no later than 12 months after the issue date of the related securities. In addition to the documents that have to be submitted for initial certification, the custodian must be in receipt of the recorded mortgage or security instrument and the final title insurance policy. GNMA 5500.3, Chapter 11, specifically states that issuers may not wait until all docs have been collected for an entire pool before delivering them to the document custodian. So make sure that your policies and procedures are developed in such a way that you're meeting these deadlines. The custodian is only required to certify that the documents JennyMay says should be in the file are actually there. They have no responsibility to communicate or to follow up with you regarding missing documents. There are some document custodians that do a better job of helping you keep track of missing documents than others do, but at the end of the day, none of them are required to do this. It's important that your procedures are able to track any documents that are missing. Our testing also found many loans that have been paid in full or removed from the pool for other various reasons, but the custodian still had all of the documents 6 to 8 months later. When a loan is removed from a pool for any reason, the request for release of documents, which is a specific HUD form, must be submitted by the issuer within 30 days. There are some subservicers that will generate this form on your behalf, but it must be signed by the issuer. This is a responsibility that cannot be delegated to your subservicer. And that comment brings us to our next finding, and that's the over-reliance on your subservicer. The most common subservicers out there are getting very sophisticated, and they're able to perform nearly all of the servicing functions on your behalf, and they're doing it really well. This is good, except that it often leads new issuers to believe that they can remove themselves from the process. There are a number of items that cannot be delegated to the subservicer for any reason. Those include the withdrawal of funds from the principal and interest custodial accounts, including signing checks or authorizing withdrawals, accounting reports and certifications to JennyMay, accessing documents at the document custodian, and that includes the forms that have to be provided to the document custodian, such as the release of security documents we just discussed, signing remittance advices, funding guarantee fees, and maintaining the register of security holders. Unfortunately, in response to questions about servicing-related items, I often hear, "I'm not sure, our subservicer does that for us." The company is completely responsible for all of the work that's performed by the subservicer. That means that monitoring procedures have to be in place in order to evaluate the performance of your subservicer. This is a hot topic for CFPB also. Your subservicer is a service provider and should be subjected to intense scrutiny regarding the way they interact with your borrowers. If you make sure you're meeting the requirements of the CFPB, then you should be covering all of JennyMay's expectations. There are a few different ways of accomplishing the monitoring, and the best option will depend on your company's resources. So some of the options our clients have been using are engaging routine operational reviews of your subservicer. Some of you have engaged our Business Advisory Services Department to perform that for you, for example. Scheduling your own on-site visits to the subservicer's operations office, and reconciling subservicer information with other internally or externally generated information. Bringing us to our final topic. The servicing portfolio is regularly in flux, and the easiest way to identify most of the common errors is to routinely reconcile your servicing portfolio. The reconciliation should reconcile the portfolio balance to your MSR asset on your financials, by investor, and also to any subservicer record. These reconciliations will give management some of the tools needed to evaluate the effectiveness of the policies and procedures that are currently in place, including timely onboarding, timely reporting of paid in full loans, and other related topics. This is also a great tie-in to your CFPB vendor management responsibilities. Ultimately, the main thing to remember is that servicing a loan requires a network of service providers, that your company is solely responsible for every activity, transaction, and borrower interaction that occurs. The document custodian is only responsible for keeping the documents secure and confirming that all documents required are in their custody. The SelfServicer is only performing the work on your behalf. You remain 100% responsible for everything they do. So make sure you know what your service providers are doing for you, have an idea of how they're providing that service on your behalf, and perform your own monitoring to make sure it's all being done as you expected. And with that, I have some time to answer questions. Okay, so one question is, does the HUD QC plan and the CMS, the Compliance Management System for CFPB, have to be separate documents? They don't have to be separate, and actually I would recommend that you try to incorporate all of your QC requirements into a single plan. Maybe your CMS has a HUD-specific chapter or something to that effect. Question about late FHA upfront MIP remittals. How do we determine what day the calendar starts ticking for the 10 or 15-day deadline? So HUD says the clock starts on the closing date or disbursement date, whichever is later. Obviously, refinances have the 3-day right of rescission, so funds are never dispersed on the closing date in refinances. And the way I explain this concept to my compliance staff when they're going through training is to consider the first day that any checks can actually be written. When the funds are legally allowed to move, the upfront MIP clock starts ticking. A question on CFPBs under management. Should we consider JennyMay a service provider that should be subjected to the extra scrutiny required by CFPB? So our current answer is we're not sure. We are consulting with some industry legal professionals, and I'm having some conversations with one of the CFPB attorneys to make sure we aren't developing an opinion that's in conflict with the CFPB's intent. As of right now, the general consensus is no, we should not be considered a service provider. However, once we feel comfortable that we've collected as much information as we need to reach a final decision, we'll communicate with you. And if it's determined that we should be included, we'll put together a package and we'll make it available to each one of you.
We have a question that came in and asked, can you please repeat what should be what we should be reconciling for subservicing?
Sure. So it depends on the type of reporting that you have with your subservicer, but some of the main things is you're going to want to make sure that the loans that are included in your servicing portfolio have a corresponding asset in your mortgage servicing rights asset on your balance sheet. You want to make sure that any internal reports of your servicing portfolio are reconciling to the loans that your subservicer believes they're servicing on your behalf. And then you will also want to make sure that you are reconciling the loans that are being serviced by each individual investor. So you should be able at any time to know the actual UPB of your entire servicing portfolio with Fannie, for example, or the UPB of all of your servicing portfolio that's in a Jenny pool. Okay. So some of you may have questions and you don't want to overload the system, or you just can't think of them right now. If you're wondering when we're available to help, my duties do still include a few financial statement audits each year, but about 85% of my job responsibilities are as the compliance specialist. And I have a team of 5 enthusiastic compliance team members We may not always be immediately available, but we're always here to help you in any research or questions. So please feel free to contact me directly or the team at the 2 email addresses that we've provided there on the last slide. And that phone number is my direct line also. I'm happy to talk about this anytime. Surprisingly enough, I really do enjoy it. So please feel free to reach out to us anytime there's anything that we might be able to help you with in this area.
Okay, I don't see any more questions. One just popped up. So what loan origination product do you find to be best in relation to compliance?
I'm not sure I understand that question.
Yeah, so if maybe whoever asked the question could be a little bit more specific. We did kind of finish up a little early here, so we do have plenty of time. If people want to start sending in some questions, we'll be glad to stay on the line and keep the webinar open. But if you're wanting to get off first, let me just say thanks again to everyone for attending today's webinar. We really appreciate everyone's participation. As always, we're trying to provide topics that are timely in today's environment, as well as they're informative to our clients and whatnot. So we welcome your ideas for future webinar topics. You can email us at info@richeymay.com, and if you got a topic that you'd like to see, we'll just try to log those and track those, and again, as I said, try to provide topics that provide value. And finally, just as a reminder, the webinar will be posted to our website shortly. So with that, we'll just stay on the line here for a couple more minutes and to see if any other questions come in. But we do thank you guys for attending and hope everyone has a good day. Okay, another question just came in. It says, is there a central repository for all of the different agency servicing requirements?
Wouldn't that be fantastic? As of right now, there is not, especially if you start trying to consider all of the individual state requirements for servicing. Unfortunately, right now, there's just not a great resource for managing all of those multiple components. A lot of the big entities, the CFPB, HUD, JennyMay, they're all conscious of the fact that these servicing requirements are pretty spread out, and part of this effort of HUD to revise their handbook is trying to incorporate as many different agency requirements as possible. But I just don't know if we're ever going to see this process become streamlined to that extent.
Okay, we got a little clarification on the prior question. It's basically which product allows a company to be in front of the compliance requirements better than others. Is Encompass 360 a best-in-class product, or would you say is more in tune with today's regulatory reporting requirements?
Encompass is definitely one of the leaders. Every software has its strengths and weaknesses. I know that Encompass has a secondary product. The name of it is escaping me right now, but it is intended to help clean up those potential compliance findings prior to closing. It helps. I'm not exactly familiar with it because it came into the industry after I left the industry, but it's some informational repository of all of your issuers' underwriting guidelines and requirements. Your investors' underwriting guidelines and requirements. I think if you're utilizing something like that, that you're probably in a much better position to catch those common human errors that cause compliance findings. But I'm not aware of one software that's really, head and shoulder above any of the others.
Okay, so we had another question regarding where do we find the CFPB requirements for handling escrows?
So the CFPB has a pretty intense guidebook. I don't know that website address off the top of my head, but I will pull that up and I can send it out to everyone, a link to their guidelines. I'll try to drill down to the specific chapter, but yeah, I will definitely get that information out to you shortly.
And for somebody who is just put in charge of formalizing a servicing platform, where would you say that they would start in terms of gathering the servicing requirements?
It's going to be a big undertaking. You're going to have to identify all of the agencies that apply to you. So you're going to need to research every state that you service for. You're going to, if you're FHA approved, if you're issuing JennyMay pools, if you're selling to Fannie, Freddie, private investors, they each have some of their own compliance requirements. So I think one of the first steps that you're going to have to take is to identify each person that you're responsible for being in compliance with, and then drilling down to their specific compliance requirements. So like I said, it's a big undertaking. I would probably focus, if you're just now starting to implement your compliance program, obviously with your initial investors, FHA, Ginnie, Fannie, Freddie, make sure you're picking up those 4 big ones and the CFPB so that you're covered if they show up knocking at your front door one day, and then expand into maybe some of those lesser used options and investors.
Well, I hope this information was helpful to everyone. I don't see any more questions that have come in. So it looks like we're pretty much done, but if after the call today or the webinar, something comes to mind, and like Gail said, feel free to reach out to us with a question, and we'll get back to you with an answer, or we'll reach out to you if we need a little bit more detail. If it's kind of situational, the response would be situational.
Yeah, we're happy to help you try to research and find those sources of compliance requirements. So please get in touch with me anytime you need any help, and I'll be happy to do my best.
And one last question, I'm sorry. There's a question that says, can the compliance management or the reporting be outsourced?
That is a good question. I'm pretty sure so my initial opinion is that yes, it can be outsourced, but in that case, you're still always going to be 100% responsible for those results. Kurt, do you?
Yeah, I know that HUD, again, this might tie into having to check each individual Fannie, Freddie, HUD, but I know that HUD in their guidance says that you can outsource it, but you're still ultimately responsible for it. So, that just keep that in mind, that just because you outsource it doesn't, relieve you from responsibility for it. Okay, well, we can stay on just a few more minutes. There are no more questions that have been asked, so we've gone to all the questions. We'll stay on just a couple more minutes, but thanks again, everyone.